Ladies and gentlemen of the crypto space, we're live on a Friday, July 11th at 11:31 a.m. I have up on the screen one of the charts that we've discussed for many years at this point, and frankly, we've waited many years for it to get to where it is. We have discussed the significance of this chart, but fine. Maybe a reminder is in order of why this chart means what it means and how it works. It's pretty simple to understand in crypto terms how it plays out in overseas banks and global markets is complicated and nuanced, but in crypto terms it's pretty easy to understand. So this chart was high, clearly close to 200, and that's an enormous number in historical terms, and has taken some years to come down. And it really started back in, let's zoom out, let's go out to the monthly chart. And it's really started in 2020 with a volatility event. Now, volatility, this word gets thrown around a lot, but it means something very simple. When things are volatile, people panic. I mean, literally, we had the White House yesterday calling people panicans. You can't make this timeline up. There's some next level shit going on. So, but volatility is literally a manifestation of panic. Now, volatility doesn't have a direction, doesn't mean down nor up, or it means both down and up. So, volatility can be to the downside and to the upside. Clearly, most people, want the volatility to be to the upside. Albeit, if you like shorting stuff, people like that volatility to the downside, and that's if you have directional exposure. So now I'm just making things all complicated. We don't do directional exposure here. We follow rule number one, own more assets. So this indicator blew out in 2020, specifically March of 2020. And that led to one of the greatest monetary interventions in hmm, humankind. All history. 2020 was historic. And then over the next, was it 2 years? Yeah, ending in end of 21. Um, Volatility remained low. So they were able to suppress volatility for quite a period of time. But now it has taken some years, 2022, 2023, 2024, and half of 2025. So we're talking about 3.5 years thus far. It has taken these bankers, these regulators, to finally quell the volatility. Now, clearly, it's always going to be new circumstances, facts and circumstances, as Gensler used to love to say. But the facts and circumstances going on right now are quite different. Look at the deficit spending. They just passed the bill, and there's a couple hundred billion that came out of Treasury. You can't make this shit up. You can't make this timeline up. But all things considered, you know, they were still able to push bond market volatility at least down to the low 80s. Um, this is not much of a volatility spike compared to what we've been seeing over the last 3.5 years, 1.31% up to 4.4 in the 10-year. I mean, this is clearly a result of deficit spending. And we understand that story. We understand they spend too much money. We understand that the money is getting debased. There's an increase in currency supply. But what people need to understand is how that currency supply gets increased and who is responsible for it. And that tells us how the system works. And that gives us our opportunity. And we understand the implications of an increasing money supply, but I don't think people really understand it in terms of fear. People are fearful of an increase in currency supply, but who's increasing it? The amount of currency getting added to the system is not in large part by the United States. That blows people's minds and it doesn't resonate with people the way it really needs to, especially when folks want to understand the way the system works. Um, you know, from a national debt standpoint, the United States has only printed about, let's say, 10% of outstanding dollars around the world. What does that even mean? What does that even mean? Okay, let's do this. I know a lot of folks have seen this over the years, but considering the markets are popping off, I might as well tell people again how money works. All right, look at this. These are 10-year treasuries, as they're called. Let's say you go to a bank and you deposit them and you say, hey, bank, I want to borrow some money. And the bank's like, oh, all right, great. You got a bunch of 10-year treasuries. And therefore, they're going to lend to you because you have something that you deposited. That's called a down payment or collateral. It's the same thing on Aave. Now, if you haven't used Aave, oof, damn, you're new to this game. I mean, this is literally just deposit collateral borrow. It's exactly what I described at a bank, except you don't have to wait 1 to 3 months for the paper pushers to approve the loan. You just deposit collateral and borrow. You get paid, and you have to pay on both sides because that's the way the system works. So the point is, let's say you're depositing not a stable coin because there's no volatility there. The problem or the complexity to understand, to really understand the way money works, is volatility. And there's no volatility in stablecoin, so there's no point in talking about it. We could talk about clearly Ethereum, and if I had WBTC on mainnet, we could talk about that too. Okay, so I got a tad of Ethereum. This allows me to do my transaction. So Ethereum, not the best example. If you go over to Optimism or have some Bitcoin, you deposit Bitcoin and it's volatile. Clearly, it's up to like 117, whatever the hell it's at right about now. 117.5. If Bitcoin drops to 90 and goes to 110 and goes to 95 and goes to 120, it's volatile. You don't know what to do. What do you think is going to happen to these interest rates? And if you borrow stable coins, that's not going to be 5%. Might be less because actually, that's not really proving my point well. Um, it'll be less because people are fearful and they're paying back their debt, which destroys money in the system. Because if someone's borrowing these currency units, um, they have an asset on their balance sheet. Well, these are really all assets. Double entry accounting is kind of funny with Aave, isn't it? These are all just a bunch of assets. Aave Go is the liability. So if you go back to mainnet, you can see Go, and that is liabilities that they print. Um, But when volatility is high, you don't want to borrow because you have no idea what the interest rates are going to do, especially with regard to variable interest rate debt. So that tends to destroy money in the system because people pay back their loans. If I borrow $100,000 and all of a sudden volatility gets high and I sell my investments and I pay back my $100,000, I just took $100,000 and destroyed it. It's not in the system anymore because I gave it back to the bank, and the bank is not doesn't have $100,000. I paid them back liabilities, and now they have unbalanced assets versus liabilities. Now they have to go sell those liabilities to someone else. All right, this is still not really hitting home as well as I'd like about how the system works. Is because you really got to understand double entry accounting and what are assets and liabilities. George Gammon had his podcast last night was really good. He was talking about gold certificates, and he talked about briefly SDR, special drawing rights from the World Bank, and how the Fed could print liabilities against them. It's just so the currency we all use comes in the form of a liability. So let's put it this way: there's two types of things you could own. Think about it in terms of A or B. Perfect example. I have two chapsticks. One of them is an asset. One of them is a liability. There's still two frickin' chapsticks. You could do very similar things with them, except one of them probably maybe has a positive interest rate, or one of them maybe has a negative interest rate. Like you have to pay on the liability side, and maybe the asset has a positive interest rate. So that's maybe a characteristic difference, but still, I could own an asset. I could own a liability. Your dollars are liabilities. You deposit treasuries in the bank, those are assets. You give the bank the title to your house, that's an asset. And they will give you a liability, which is a mortgage, or they'll give you a deposit into a bank account, a HELOC, home equity line of credit. You're still going to give them the title, and they'll give you a deposit into a bank account. It's our liabilities. Now, the weird thing is, you could spend those liabilities just as you could spend dollars, actual paper dollars, which are still liabilities. It's still a liability no matter what, even the paper dollars. Except the paper dollars are direct liabilities of the Fed, whereas bank deposits are liabilities of the bank. So bank deposits are bank money. Paper dollars are Fed money, so to speak. So it's all a bunch of smoke and mirrors and a bunch of bullshit. So what's pertinent is what are the conditions in which currency supply expands and contracts? And that's the most important thing with regard to capital management because that tells us our timetables. That tells us the when. It also gives us a sense of the where. That's another story. The where is investment methodology. So the when is something we've been waiting for some years. Let's go back to, and this is great because we're finally seeing move come down and DXY hit a bump today. It's probably with those 30+% Canadian tariffs. Not that their currency contributes much, if anything, to the DXY as compared to the euro, but obviously across Canada, euro. So everything bleeds together. Everything affects everything. There's a knock-on effect across the entire system. So the point is, you're up in 97.7 on the DXY. We were down in the 96 region. And that is a decent candle off the bottom. We are above the 200 EMA on the monthly. So the system is not in prime currency printing territory. And just to be clear, I'm not talking about currency printing, ooh, Fed printer go burr, or Treasury issuing $400 billion worth of debt. That's not the currency printer that I give a shit about. I mean, quantitative easing is a hell of a drug, but even that I'm not interested in. Everyone gets sidetracked and they don't care or not possible for them to process beyond the social media headline. Ooh, Fed printer go burr. That's not what it does. They're modifying bond market volatility. They're the debt market, the whole thing, the whole yield curve. They're trying to influence it, and Treasuries has their buyback program. So they're trying to massage interest rates across the curve, and all of that, whether the Fed is doing QE or Treasury is doing buybacks or no matter what, all of it is indirectly affecting volatility. So you have the largest actor in the room, and and that's exactly what's happening. Volatility is getting suppressed over time. It takes a lot to suppress volatility. It takes a lot to calm people down. But that's where they finally are. We'll see what happens after today's 1.4% pop on the 10-year. But if move finally shows some downward directionality below that green line, because that green line, 82.43, was a double wick. You see that? It was a double wick to the downside back in 24. Finally, this is the first week. Right now, this is the first 2 days? No, this is the first day. Ladies and gentlemen, we're on day one of the lowest move indicator value in 3.5 years, give or take. But yeah, this chart right here tells you prime money printing season by who counts, and that's the rest of the world. It's not the United States. It's not the banks in the United States issuing mortgages and HELOCs. No, this is small potatoes. The vast majority of dollars on the planet were printed outside of the United States in the Eurodollar market. The Eurodollar market is exactly what I just described, where I go to a bank, I deposit some collateral, some property in Malaysia, and they give me a line of credit on $5 million off $10 million worth of property. And that line of credit is liabilities, dollar liabilities. It's not dollars, but it's liabilities of dollars, which are the same thing, except it's bank dollars instead of Fed dollars. So that credit is the printing of currency. But that credit is only extended when the volatility in the collateral is low. So I gave you an example of collateral being property, which is generally low. So it's easy to borrow against property. Maybe easier. Uh, well, generally, the treasury market is supposed to be the deepest, most liquid market in the world, as Yellen used to love to say. So the point is, the real estate market does prop up the entire system in many regards. It's always easy to borrow against real estate, but it's not so liquid. So the treasury market is much more liquid. But when the volatility is high, it shuts down the credit process. The bank's like, all right, fine. I don't know what the interest rate's going to be 6 months from now, so I'm only going to give you $1 million on 5 million, and they don't extend as much credit as the system probably wants. When the volatility starts rolling lower, that's when the banks are like, all right, fine, here's some credit. I know, I'm pretty sure what interest rates are going to be in the next 6 months. So here's a 6 month loan. Hey, if you guys ever seen the movie Margin Call, that's a good example. So they use leverage, and they kept those assets on the books for longer than they would like, as they nicely state in the movie. And that those algorithms and those values and that data, that range they were talking about was volatility. And those algorithms don't crunch, don't work when the volatility is high. And that means you're taking too much risk holding it on your books. You have your risk thresholds because you have a potential loss. Just like they said, if you have a 10% drop in asset prices, and then in the movies something like this, it's a little larger than the market capitalization of the company, because that's how much leverage they got out in the market. But when the volatility is low, the whole thing works. The carry trades, the leverage, and that's the whole point, ladies and gentlemen. That's the whole point. The volatility is low, the system expands, nobody's panicking. When the volatility is high, everyone's panicking. So we're about You are on day one, today, Friday, July 11th. This is the lowest move value in 3.5 years. If it continues to go down from here, you will see increased credit across the planet, see an increased currency supply across the planet. We've already seen forward-looking indicators on M2, but M2 is a small part of global currency supply. The shadow banking system is where the real money is, the hundreds of trillions of dollars, several hundred. So you start to see move fall below 80 into the 70s and down, and that's when it gets weird. And it won't even be dependent on the DXY going down too much. Move runs on its own. But obviously, if the dollar follows suit, we've talked about the DXY and the weekly for quite some time with the guppies. We go over here and we have the guppies loaded. Well, your red guppies is prime time for crypto to do what crypto does. This is a great looking chart in that regard. Oh, everything's aligned. Let me look at gold. Jesus, 33.59. Wow. It's just caused bullshit in the entire system. Even oil is perking up. So this is all good yet bad. I guess I remind folks that everything that people understand how bad the system is, they're right. And that's separate and apart. Oh, the system's going to fall. Yeah, of course the system's going to fall apart. None of this is sustainable. It's perverted, it's toxic. But these businesses are coming, these crypto fintech businesses, and they will print cash flow that adjusts for inflation because as the currency supply increases, transaction volume will increase and therefore cash flows will increase. So you'll get more cash flow as there's more currency, as there's more transactions, especially as there's adoption. So that just takes it to another level, the concept of where we are from a crypto market, a crypto economy adoption standpoint. None of this has been monetized. It's microscopic market caps. Oh, in 2030, this is going to be so weird to look at, you know, when Abe's run around at like 100 bill, curve run around 50, 100, but it's at a bill market cap, give or take. Bill two, these things go 50x, 100x on the money because these are big businesses. And I think those are reasonable market caps for these types of businesses because you got the businesses on the stock markets, the equity indices. They're very popular businesses. And these businesses have a lot of people and employees in real estate. But that's exactly why crypto should probably be valued more or greater because it has none of the baggage of traditional enterprise. And that comes back to the investment perspective on markets. You have the timing of the markets where we understand how money is printed, what money is, what currency is, because money isn't currency, two different things, and how it's printed and who prints it. And we get over the social media dum-dum phase of, oh, the US prints the currency. No, it's the rest of the world that prints the currency. And they choose to, they opt in. They're like, hi, I'm going to bury myself under a pile of dollar debt because they choose to. And that's what the world has done for a long time now. They said, yes, I want to do that. And they did that. And then you have the other side of what we do is picking what to invest in. And we've been talking about that for going on 4 years. No, we've been doing this, what, since late 2020? Shit, hasn't really been 5 years we've been doing this stream. I'm an old man now. Oh dear. Sir Joe, President accounted for. Much pleasure. Happy Friday, Brian. DCA man, good morning. Albert, yes. Thought a concept, grand rising cab. How do I explain to someone how these assets are one of one assets compared to stocks and that it involves biggest business in the world? You can't. You have to first, people have to first understand what money is. Um, to understand how a crypto is a business, they have to understand the five businesses of crypto: foreign exchange, credit, derivatives, liquidity, financing, and liability printing. But why are those businesses? What the hell is foreign exchange? To understand foreign exchange, you got to understand what a currency is. To understand what a currency is, you got to understand how countries use money to print currency, how double entry accounting works, how central banking works, how what is the composition of the global currency supply. It's literally what I talked about at the beginning of the stream. Everyone thinks the US prints a lot of money and the rest of the world has printed 9 times more dollars than we have. If we printed 40 trillion, the rest of the world printed 400 trillion. It is, Mike Howell talks about a number about $300 trillion. All right. Our national debt is a lot less than that. But he talks about it in terms of refinancing capacity. There's no true number of how many dollars are in circulation, but we understand the mechanic and how the dollars are created. And that's because of double entry accounting. So that's why it's not easy, athletic concept. Double entry accounting, assets and liabilities. And our currency is a liability against an asset. We're balanced by an asset, rather. It's not really one of one. One of one. It's like an NFT type of statement. But we do have the concept of fully diluted and non-expanding supply, like liquidity. There's all emissions, everything's out there, and there's no dilution. Um, I do like the idea of the disinflationary dilution. There's built-in monetary policy. So when you got equities and stocks on stock markets, and the company's like, I'm going to dump $100 million on these retail plebs and raise 100 mil, so I could raise money. Because that's what companies do. They sell stock to raise money, and they dump it on the general public. And the general public's here. I'm going to buy your stock because some other dumb motherfucker's going to buy the stock from me for more money. Um, so that's the monetary policy. It's based on a boardroom. Whereas in crypto, look how Velodrome and Aerodrome handle it. It's an immutable, deterministic monetary policy. And even base voter escrow is immutable and deterministic, and they're disinflationary monetary policies. All of them are. All the B33s, Velodrome, Aerodrome, Curve, yada, yada, yada. All the kingdoms are disinflationary monetary policies. So it's a little different than a stock, right? Company, where the board says, I want to dump this stock on this retail. Like these are deterministic. You did not see that stock issuance coming from the board. The board's like on a on after a board meeting, they're like, oh, we're gonna do this. It's a good idea. Whereas with the crypto fintech businesses, it doesn't work like that. There's no board. It's the monetary policy. Here is the issuance. This is how much issuance there will be. And next year there will be less. And the year after there will be less. And that's literally Bitcoin. Bitcoin is a disinflationary monetary policy. That whole fixed supply is the most insane narrative I've ever heard. Bitcoin is an increasing supply currency. Every day there is more and more and more Bitcoin in circulation that is printed. And clearly there's Bitcoin that is lost and not destroyed, but unrecoverable. And clearly there's a timeline, 2144, when the last Bitcoin will be mined. And that whole conversation, you will all be dead. So who cares about the conversation, in my opinion? But what do I care about? Friday. So next Friday, there will be more Bitcoin in circulation. It's a disinflationary monetary policy. Curve's a disinflationary monetary policy. The VE33s are disinflationary monetary policies. It's just, Ethereum's a different beast. But I'm not here to talk about proof of work, proof of stake, and shit like that. That's a whole nother story. But those are cash instruments, as I define them. The Bitcoin, the Ethereums, the Solanas, cash instruments. So I hope that helps. It's a good statement. Not an easy answer, but leads to a decent conversation. If anyone is on X or YouTube, if you have any questions, please feel welcome to ask them. Greg, I've never been prouder of my portfolio. Sleep like a baby. Thanks for keeping it real, Cap. Much a pleasure. I sleep well. I don't think about. I think about the rules. I mean, I get cash flow. If I'm not spending it, I'm accumulating capital that can be used to acquire assets or buy things. I put money on a debit card and I could pay for things. I go here, I go to the Spritz. Oh, I'm not signed in. And you go to card and you go to the supermarket, you go to the gas station, you put it on Amazon, and it's like, "Look, here's that's how you use crypto." So now the question is, how do you get crypto? And you own assets, and those assets pay you. So it's pretty simple. And if you want the assets to pay you more, you have to own more assets. So if you want to own more assets, it takes time because I don't take risk, I don't gamble, I don't speculate, I don't do leverage, whatever these kids are doing nowadays, because I don't risk my capital. I work hard for my money. I'm older. I've been doing this industry thing for 20 years. I'm in my 40s. So I worked for a decade until my 30s. And then it was not even my 30s because it was 2019. In 2019, I sold my rollover IRA, which was the culmination of about 4 or 5 corporate jobs rolled over. The 401ks rolled over into the rollover IRA, paid a whole bunch of penalties. That's what I did back then. I didn't sell it all. I still have stuff in that, whatever they call it, a brokerage account, where all the boomers keep their money, all the old people that couldn't think outside the box back then. It's still hard to think outside the box, but I don't know. I think it's getting a little easier. This is a much more respectable place to deploy capital. Well, it was very different back in 2019. And dare we talk about earlier, no such thing as cash flow in crypto fintech in 2016, 2017. I 2017, 2016, end of 2016, 2017, I had 13 1080 Ti's on a kitchen countertop in an apartment building in Orlando, Florida, right across the street from SeaWorld. I think I was drawing like 2 or 3 kilowatts, and I had to have 2 circuit breakers because one breaker couldn't handle the amperage. Three breakers, so it didn't trip the breakers. There's something like $400 a month in an electric bill in a one-bedroom apartment in Orlando. It was because of the ACs, though. That killed me. I was literally 100 degrees outside. It's or it's Florida. So I was literally running a heater and ACs to cancel out the heaters. I don't know, that was crazy, but that was a long time ago. And this market that we're looking at now is not that. That is a different world. In fact, that is even a different world. That is, it's not even a comparable world. What was back then. Um, there was no market, there was no finance, there was no credit, there was none of the five businesses: foreign exchange, credit, derivatives, liquidity, financing, and liability printing. And frankly, I've defined those businesses. The only one who's defined those businesses. But those didn't exist until 2020. Liability printing. I mean, that didn't really come along until the first on-chain stables. I mean, I guess Tether is a liability. It's collateralized, whereas USDC is more so like a tokenized representation. It's not really a liability. One USDC is redeemable for a bank deposit, which is fine, and that's what a payment stablecoin is. I mean, Tether's not really a payment stablecoin. It's designed to be a dollar liability, which is basically a bank deposit. Um, so it's a bank deposit that's it's kind of like a bank deposit that doesn't have a Fed account. I don't know, because HSBC bank deposits are transferable to Chase. Isn't that weird? How the banks all work together so they have these interoperable liabilities. If I send $1,000 from a Chase account to an HSBC account, I'm able to send Chase liabilities to HSBC. What does that even mean? So I don't understand that interoperability. It's a liability. It's not like I'm sending dollars. I'm sending a bank deposit. That's weird. And how it works mechanically, I don't know. So the USDC are like tokenized bank deposits, and Tether's like a tokenized liability, but it's a non-compatible bank deposit. It's not redeemable in the same way. They don't have the same deposits that it would draw. Anyway, okay, so in 2020, the first stable coins. I mean, now we have obviously home accepted names, brand names: CRV, USD, Frax, MIM, whatever the hell, USDS and Spark and whatever was left of MakerDAO, and F of X and Aladdin DAO and all these stable coins. And it's a big deal. I mean, there's not actually not many dollars. Go figure. Dollar, dollar. These guys don't know. That's not really any. Well, I mean, what's the interesting ones? You have, in my opinion, the Go, Dollar, Aave, MIM, USDS, and CRVUSD. Frax. That's about it. There's not many dollar liability platforms out there, like real dollar liability platforms. That's very interesting, to say the least. That should say something from an investment standpoint. And that's why nobody understands Curve. Everyone's like, ooh, the Curve exchange. Gives a shit about their decentralized exchange. What I understand is that Curve is now a dollar liability platform that has a fully integrated, vertically integrated stack of infrastructure to support the dollar liabilities. Full stop. That's insane. It's fully integrated. Pretty wild if you think about it. That's pretty wild when I think about it. And I've been thinking about it for a long time, and it doesn't get any less wild. Absolutely insane. Curve is the only protocol in crypto, all of crypto, that is the five businesses. First off, I defined the five businesses, so most people don't talk about this shit. Second of all, Curve is the only protocol in the whole crypto space that is all five businesses. No one else is that. You're investing in Aerodrome, that is foreign exchange and liquidity financing. It's not really derivatives. It's no credit, no liability printing. So it's not the five businesses. There's no protocol out there other than Curve that's the five businesses. Period. Anyhow, hope that helps, guys. Soon, much a pleasure. Much a pleasure. Kill us in the house. JM, dang, I've been waiting for this money expansion moment for so long, but still feel underallocated. There's no reason to feel underallocated. The appropriate place to find yourself is that you are allocated and it's the best you can do. You cannot do more than you can do. So we always wish we had more of a good thing, but that's something to get over. That's something to cure. It's a perspective that is not sustainable. It's not really healthy either. We must be accepting and humble enough to be appreciative of what we have right now and the work we put in to have what we have right now. To be grateful for the portfolios we built over the last couple of years, knowing how the system works, learning how I've talked about it and the things you guys have said and things I hear on social media have affected the way I think and have led to these stories that have led to today, to the move indicator getting below where we've long talked. We're looking for it to get below. How long have we? I mean, we've literally. I'm. I'm not the best technical guy. There's a lot of folks that do much more interesting technicals that tell us where things are. But I've looked for a long time. I wanted to see move get back down, down to an average value. And it turns out this green line was a decent green line to draw because it was these double taps in 2024. So we didn't have them in 23 or 22 to draw, but we knew we had to come down. But it turns out this level right here is pretty interesting. Resistance, 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 resistance. So I like this. It's something I've drawn on the DXY as well. We'll go over there. So we were stuck up here, the 107.35 for quite some time, if you guys remember, and the 103.81. We were talking about those levels for quite some time, but we're way below them now, way below that 103.81 line. But those lines go all the way back. Look, the 107.35 goes all the way back to 1976. And the 103.81 line goes all the way back to 2016. You see that? Pretty interesting lines. You pretty obviously stopped out in 2020, didn't even get close. Well, kind of got close, but it wicked really hard. The 2016 line, the 103.8 line. So you get these average lines that tell us, all right, we start to get below this level. It's starting to get interesting. And that's exactly where we are right now. It's starting to get interesting. Now, maybe the DXY, I would say where we are right now, the move is a foreshadow of where I expect the DXY to start to head. So if move starts to really push down into the 70s, I would expect the DXY to punch the 200 EMA on the monthly. And then that's when it's getting weird. And that's really what leads us to 2025 compared to like 2019 and 2016. I don't go back to 2013. That's a whole nother world back then, 2012, 2013. But let's say 2016. So 2016, 2019, 2020, leading into 2020. Because if you're thinking in terms of 2016, here's your entire world. It's your whole world right here. That's it. But look, there's just so much history back here. Oh, what the hell is going on back here? Oh, what does this tell us about? And this comes the story that I've told you over the last maybe 2 years. Not really 22, more so 23 plus. Um, it could get really weird. So this is why rule number one is so important: own more assets and to just be grateful for what you have because the potential monetization is extraordinary. I mean, 100x across the board, that changes everything. Um, or even more. The potentials, that's why, that's how extraordinary the potential is. We're on super cycle territory, ladies and gentlemen. We just had blow off into 107.35, one of the largest wicks on the 6 month chart. First off, no one looks at the 6 month chart, only the captain. So I'm the only one crazy enough to look at this chart. So these two things are absolutely insane. One, two. Those are some of the biggest wicks in in history of the dollar. The last time we saw a dollar DXY wick that we saw in 22 was in 1985, and then we saw a return to this base. And this base is a heck of a base. We go to the monthly, everything lines up. You can see that wick down there. See the wick down here. So it's kind of like over the next 10 years, lower high, lower low, and you finally get down to a blow off bottom at like 68. And you look at that. Doesn't that look like it makes symmetrical sense? And this is early, it's 32. I would say because of how long it took. We've been in a bull market on the dollar since 2008 until 2022. 2008 to 2022. 2008, 2022, January 23. So check back in 2035. We could easily see. So we've never seen what crypto markets are with regard to monetization in a dollar depreciative environment. So we've never seen anything like this. This is all crypto. This is basically all of crypto's history. I mean, obviously Bitcoin was born down here in 2008, but this was a weird time back here. That was a weird time. But you get to 16 and you're over here. So pre-16 it was different. It's different. That was even 16 and 17 were weird. That was literally like Bitcoin crisis, identity crisis territory. There's all the Bitcoin forks and all the masternodes, and nothing survived. Syscoin survived, Zcoin, and a couple of other things with massive treasuries. That's about it. And then, oh, there you go. So this little world we have over here. Even this little world isn't what people think it is because most people understand crypto from where it is right now and what it's doing right now. And what it's doing right now is only here. This whole concept of markets and economies and dollars and credit and the five businesses, it's only right here. But crypto existed all throughout this. So these are this is two different universes, two completely different universes. So my 2 cents is over the next 10 years, crypto is going to be monetized in a dollar depreciative environment. This is the best investment probably in history. Principal goes up and to the right, cash flow goes up and to the right. I've never seen it, but I'm young, I guess. I never saw like the 1987 market and how hot things got in '86. I never really. I was young in 1999. I didn't know these markets. I was in my teens. I sure as hell didn't know the real estate bubble in 2002 to 2007, 8. I don't know any of those markets. All I know is this market. And all I know is the potential investment opportunities. What are the choices? I know what I know enough about history to say everything else sucks. Everything else is a horrible, horrible deal compared to the things we talk about. Anyway, okay, I hope that helps. So, JM, how do you feel? I feel cool, calm, and collected, and I'm grateful. I wake up and I know it's easy to want to have more. It's easy to say, I could have, I don't know. I am so grateful just to have what I have. And I don't care what other people have. All I know is what I have. It's enough. It's enough for me. And I made it. I built it. I made these choices. I told these stories and just thankful that I have that kind of quantitative mind. I'm a reductionist and I have this capacity to be consistent, reliable, determined, and I stick to things. And when I identified the three rules, I followed the three rules. One, own more assets. Two, know when to stop buying assets. Don't buy assets when they're expensive. And number three, fuck you, pay me. So number three is a qualification for assets. I'm not going to buy an asset unless you're paying me. Otherwise, it's a shit investment. Pretty simple. Because even an asset that pays you isn't necessarily the best investment. Greatest tech isn't always the greatest investment, and businesses have their ups and their downs. And not every business succeeds. But all you need, like you invested in 10 things in 2009, and one of them was Amazon. You did pretty good. Eight of those things failed. One of them was Amazon. One of them was Microsoft. And all you need is one or two things. So that's why you have rule number one, own more assets. You have a diversified portfolio of cash flow paying assets. If one of them succeeds, great. Oh, if two of them succeeds, all right, you made some good choices. And if they get big, that's why you diversify a bit. If they get big, then you do good. And you did good. And you will do good as the cash flow continues to come in. Hope that helps. Be humble. Joel in the house, good morning. Much a pleasure. DCA man. I thought Frax had also the five business types too. The liabilities, big guys are, okay, so Frax does have credit. Frax does have foreign exchange. Frax surely has derivatives. I mean, convex is literally a Frax derivative. Frax, I mean, technically it has liability printing, but and of course it has liability printing. I'm sorry, that's what Frax is. It doesn't have liquidity financing. I mean, it does because it has the gauges. If you go over to, so it does, okay, fine. You know, DCA man, you make a good point. So obviously Frax has underperformed as compared to Curve, even though they both have the five businesses. That's actually really interesting. They do have the five businesses. Hmm. Okay, I'm gonna have to think about that one. But obviously, I have exposure to Frax, and that's exactly why I've always had exposure to Frax. And I've also understood it has underperformed. It not has not done very well. But that's separate apart from the fact of how I manage capital. Rule number one is buy assets. It doesn't say sell an asset. There's no sell assets in my rules. There's buy assets. That's just my rules. I know other folks would liquidate things if you can, and I have as well. Like I sold off Convex or I sold off Aura. So maybe there's room for like a 1B or a 2B or something. But generally speaking, when you're buying an asset, you should be thinking in terms of owning it in perpetuity, because that is the simplest way to own an asset. And that's why I like the locked positions. So I'm afforded Frax exposure vis-a-vis something I locked when Frax basically launched. I'm happy I locked it. I love the locked positions because then I don't even have to think about selling it. And that's exactly what I want to do. Not think about things. I want to buy things. I want to buy things and let the things that I buy make capital so I can buy things. I don't want to have to think about selling and when to time markets and when the market top is. And that's a whole bunch of shit that I don't want to think about. I want to keep it simple. So I hope that explains a little bit of how I think. George, good morning. Much a pleasure. DCA man, you're very welcome as always. Okay. I think we'll wrap it up for today. Not bad. Market looks lovely. 117 and change. Oh, spell up at 5110. That's nice to see. This I love this asset because Abracadabra is one of the few protocols, one of the few businesses that truly understands liquidity financing. And they have that on autopilot. So they're one of, they have supported me in so many ways vis-a-vis vote market, obviously. So I'm grateful for them and what they did and what they built because they've paid every week for the last 3+ years on vote market like a metronome. Incredibly reliable. Absolutely remarkable. Friday, July 11th, 12:28 p.m. Thank you all for joining me today. I wish you all a lovely weekend. Stay calm, cool, collected. You know, woosah, woosah. Sit in the sauna for a little bit. Watch the grass grow. Even though the market's getting frothy, this is going to be exciting, ladies and gentlemen. But don't get excited. Stay calm. Stay in control. And that will make all the difference. 395 people made it to the end of the stream, and you are all now that much more rational because of it. I will see you, ladies and gentlemen, next week. Until then, peace.